Well, welcome back, everybody, to the Confident Advisor Practice Podcast. My name is Adam Fagora, and next to me is Vincent Randazzo. Welcome, Vincent.
Hi, Adam. How you doing?
Good. Vincent is the founder of You Right Advisors and creator of the Defender Program, a systematic, risk-managed equity overlay designed to help wealth managers navigate market cycles with confidence. With over 20 years of experience in technical and macro research, Vincent previously served as Chief Market Strategist at Lowry Research and Head of Technical Research at CFRA. A chartered market technician since 2008, he is known for translating complex market signals into clear, actionable strategies. His Defender program leverages century-old market breadth principles to reduce equity risk without overtrading, helping advisors guide clients through volatility with discipline and clarity. Based in Jupiter, Florida, Vincent is an Eagle Scout and holds a BA in economics from Drew University. And today, Vincent is going to share with us why advisors need a repeatable risk management framework and why a process around this is so important. With that, Vincent, let's get started today. Why in your mind is it so crucial for advisors to have a repeatable risk management framework in today's market environment?
Yeah, well, thanks for the question, Adam, and the introduction. And I appreciate the opportunity to be here and sort of share the message. I think it's one that should be delivered and more advisors need to hear. For me, it comes down to mindset and preparation. And I've carried that idea with me since I was a kid. You know, the Scout motto is be prepared, and it's stuck, right? When you're prepared, you automatically feel more confident, and clients pick up on that, right? And in this profession of managing money, it's really difficult, but I think what most people would tell you is that mindset is what determines a lot of the success you're going to achieve. But without a framework, you're left sort of reaching and reacting to headlines and emotions, and that's not going to be a repeatable process. Even if you get it right, it's not repeatable, right? And if you don't have that, it's going to give you, if you get confidence from it, it's going to give you a false sense of confidence. But more often than not, since it's not repeatable, you shouldn't really have too much confidence in that. And I tell advisors, think of risk management like insurance for your biggest financial asset, your book of business, right? And then as I tell them how you might explain it to their own clients, I say, hey, compare it to a seatbelt for your portfolio, right? You don't wear a seatbelt because you expect an accident, but because there's always a risk that there's going to be one.
Yeah. No, I like that analogy as well. That's something really relatable to relatable to everybody, essentially. Yep. You talked about really what that mindset is as well, and hopefully most advisors, not all advisors, are really in that mindset. But what's a mistake that you've seen often with advisors when they manage risk, especially during downturns?
Yeah, I think that the biggest mistake I see is really waiting too long to act, because by then emotions have sort of gotten to you, if not through your clients, through your own psyche, and after the decline has already happened, then you do something like sell, and depending on where your client is in their financial journey, then that mistake or those types of mistakes can really impair the long-term compounding equation. And then of course you have that decision tree that you're left with. Okay, then you've got to make more decisions. Okay, when to get back in, under what condition, under what circumstance, and that's after you've already sort of convinced yourself to get out. So the answer is not to necessarily never get out, because that's buy and hold, and we know that that's commoditized, but it's to manage risk according to a process. So for us, risk management is not about calling things perfectly. It's about having a plan in place ahead of time. And if you've already built the framework, then you're leading the conversation with clients instead of reacting to it.
Yeah. Yeah, I want to get into the Defender program, right? You created this. It's really a great thing for you and how you built for your firm. Can you walk us through the genesis of the Defender program and how it really addresses some of the challenges that you're discussing?
Sure. So as you mentioned earlier, the Defender program is a subscription service. It's built to help advisors navigate market turns through full cycles with confidence, right? And so it delivers real-time signals that reduce risk ahead of those downturns, and really without giving up the gains on the upside. So we're still participating in most of the bull market. We are just stepping out of the way when you've got a high probability of a sustained or severe drawdown. So advisors can act decisively instead of just reacting, right? So for example, this year when the S&P had a 19% drawdown, portfolios using Defender were limited those losses to about 8.5% or even less in some cases. And I developed it after seeing so many advisors struggle because they didn't have a repeatable rules-based process. Like I said, some get lucky, most don't. But you need, if you don't fall in either of those camps, and most people don't, then you really do need to have a process. And I've specialized in this through my whole career, 25 years, and I was lucky enough to have been mentored by some of the best within my specific discipline. And by analyzing over a century of market data, things like breadth, momentum, risk appetite, I built an overlay that just adjusts exposure as those conditions change. So I see it as being adaptive, and I think through a cycle you do need to be adaptive. You can't be static, right? So the program is really designed to be a complement to existing strategies, really just keeping advisors in control, but adding an extra layer of clarity and, like you said, confidence. And that helps improve client outcomes and communicate effectively both during market volatility, but also when those opportunities arise and you might still be gun shy, but again, you've got a process, right?
Yeah, I think the process is the key. I had a mentor tell me my entire career, right? If you have a problem, you create a process, it will no longer be a problem anymore. Right. You're able to follow it at that point. Yep. What inspired you to create the Defender program?
Honestly, I spent ever since I got out of school, I spent most of my career helping financial advisors, and it was seeing portfolios take hits. Because remember, I got out of school, it was 2002. So I went through, the end of that bear market, and then of course I saw the 2008, 2009 bear market, and what I saw and what really got to me was this idea that these portfolios were taking these hits that in some cases might not be recoverable for years and years and years, and time again, advisors, even the ones with great instincts, were really left without a system to back them up and to sort of guide them through this, because these things do happen rarely, but they do happen with some regularity. Every about, not as severe as those bear markets, but after about 3.5 years, you usually do get a 20% or so drawdown. That's normal, right? And Defender was my way of saying, let's make discipline automatic so that advisors can turn that uncertainty into opportunity. And like you said earlier, about process, whether it's getting your body in shape, eating better, or studying for the CFP, discipline and consistency are the keys to accomplishing whatever goals you have, right?
Yeah, so it's about having those right habits. I teach that to advisors all the time, especially if someone's brand new into the business, is like, let's start the habits early and often. So it's very important. You talked about helping advisors with this program, and that's really what this podcast is all about, is helping advisors. How do you see your process really help advisors simplify decision making and reduce the emotional stress for themselves and for their clients?
Yeah, I think it's a great follow-on question, and when you have clear rules, you stop second-guessing yourself, and we all go down those rabbit holes of second-guessing, self-doubt, no matter who you are. And honestly, that's probably a good thing when it comes to being portfolio manager, because you don't want to be overconfident either, but you certainly don't want to be second-guessing yourself at every turn. And that's something I've learned over my decades in the business, that it's better to actually have some kind of platform or process to make you feel prepared. When you're calmer, and you're able to keep that big picture in sight. When you're in the middle of a battle, adrenaline is pumping, think about it that way, you're not thinking clearly. You're not thinking about the long term. You're just thinking about survival. And that, when it comes to portfolio management, that is not a good mindset to be in. So, advisors who do use our program, they tell us basically kind of sleep better at night. There's less of those hand-holding conversations, which can be really tough and uncomfortable, because they're being proactive about how they're communicating to clients, and that there's a plan in place, so they can look their client in the eye and say, we're following a process, and just that, I think, takes so much anxiety out of the conversation. And by actively managing risk, not only, like I said, you're going to have better financial results over the long term by smoothing out that compounding equation, but you're going to preserve your, what I call, psychological capital, right? And that's something that's hard to put a price on, and that goes for the advisors and, of course, the clients, right? And I think they kind of go hand in hand at times, especially when you come to big market stress points where you can sort of feed each other in a negative way or a positive way. So I think feeding them in a positive way through calmness is going to be a lot better for the financial results.
Now, I like that point there, and I always think about it as, what keeps you up at night type of situation. And I think about it from an advisor side, but of course from, advisors meeting with the clients is what keeps them up at night. And it's, all right, can I rest my head on the pillow and go to sleep? So type of situation for sure. We're obviously in a world that advisors always need to differentiate themselves. They're always trying to find different ways that they can do that. How do you think advisors can continue to show and add value to clients and differentiate themselves?
For sure, and I think it's so valid and timely to talk about this right now, because you've got, of course, this enormous ETF industry that is really popularized and capitalized on simple buy and hold strategy, right? And they charge very little for it. And then, of course, you have the rise of robo-advisors and an AI on top of that. So yeah, I think it's such a great point. And I think if you boil it down to what I think is the most direct path to demonstrate value through my lens to clients from advisors, I think you have to go back to talking to the majority of investors. And when you do, whether they say it or not, and I think advisors would agree with this, and the ones that I've spoken to, they certainly do agree with this, is that whether they say it or not, there's this expectation that their advisor is going to protect them when the market gets ugly. And if you demonstrate that you've thought about it, and beyond that, you've got a real process for that situation, that's huge. And in an environment where, like I said, fees are already under pressure, I don't think the answer is lower prices, right? The answer is showing clients the extra value that you're bringing, so that investors are reminded of the benefits of the service that they're getting, and they don't even think about its price.
Yeah. You're right. Everything on TV now talks about fees this way or that. It's become so much more transparent that you really need to be able to show that it doesn't, prices that will stick at the back of their head at that point.
Right.
You talked about buy and hold, and we know a lot of advisors do that, and obviously you have a different strategy about that. How have you, really discussing bringing this up with advisors and then showing them this different way?
Yeah, I position what I do as a smart buy and hold, because for the most part, that's what we're doing.
Yeah.
But we really are just wanting to avoid those big drawdowns, because if you look at the math of compounding, the way it works, the textbooks say, okay, 9% a year on average. It's like, okay, well then you just sort of extrapolate that in the future and everything's great. But that's an average number. The real numbers, and it depends on where you are in your journey, are going to look different, right? I mean, another 9% equation that it averages to 9% is minus 30, 27, and 30, right? That also averages to 9. So, but the problem is that the math equation is totally different. And then you take that beyond 3 years to 30 years or 40 years, or how much time you have left. Now you're talking about a totally different mathematics. So I think if we just create this what I call a smart buy and hold, then I think that's the answer. And I would say when you're conveying this kind of message to clients, keep it simple. I often tell, our clients, which are the advisors, our job isn't to call the exact top, and they can convey this to their clients as well, is to dial back exposure when the probabilities shift against us, and then lean back in when things improve or before, or like slightly before they improve. Yeah. And to me, that makes sense to people. And then I'll go back to the seatbelt analogy because I think it's just so easy to understand. Now the seatbelt, it doesn't keep you from driving, but it minimizes the damage if you hit a bump in the road. Yeah. And clients seem to understand that pretty immediately.
Yeah, I'm with you on that. I think that makes a lot of sense. And I think that analogy just really helps, especially if you're explaining this to a client, right? Like, we want to explain that downside protection, and we want to make sure that they're trusting us and they can sleep at night and they have the feet at the back of their head as well. It's not top of mind for them. And they're not sitting there in front of their computer and staring at the markets on a daily basis either. Because we know there's certain clients that do that. And there's other clients, when you look at it from a full financial picture here, we don't need to look at this on a day-by-day basis type of situation.
Right, right.
Yeah. What's one key insight that, from your experience analyzing over 100 years of market breadth data, what do you see out there?
What jumps out at me, and the biggest thing for me, is that the market usually whispers before it shouts. And, I'll use, breadth for that. Breadth and internal strength, they tend to weaken or strengthen before the prices or the headlines catch up. And I think this is really counterintuitive to most people of major market tops, because most people think of a final top, it's a party, all stocks are hitting highs, everything's great. But if you look at the data, going back again 100 years, it's just not true of tops. On average, when you're hitting the final bull market high in the major indices, you actually have mid-single digit percentages of stocks hitting highs, and you typically have over 30% of stocks that are down more than 20% below their 52-week highs at a top. So that's, again, totally counter to the way people think about tops. And the reason why that happens is it comes down to the way the indexes are weighted. They are so heavily weighted in any time period toward the largest stocks, because you have market cap weighted indexes, and those stocks are usually the last to decline. So you have this sort of mirage at the end of bull markets where it looks on the surface, if you're looking at the major price indexes, you're like, this is great, everything is great. But you look at your portfolio, and if your portfolio doesn't represent what those indices look like, then you might be saying, what's the disconnect here? Yeah. Because I'm not seeing that same kind of thing. And that's another red flag. But the point is, if you're watching what's under the hood, you can prepare ahead of the time, instead of reacting after the fact. And that preparation, again, translates directly into confidence, both for you, the advisor, and for the client who knows that, hey, my advisor has got this covered.
Yeah, and that's what it comes down to at the end of the day, that confidence and clarity that, all right, my advisor has this covered. This is not something I need to be concerned about as much, right? It goes back to what keeps you up at night type of conversation, right? Yeah. I know your clients are the advisors as well. So what final advice would you give to advisors seeking to implement a systematic risk management framework?
I guess what I would tell them is that, I love the way, this podcast is focused on advisor confidence. But I would agree, and I would say competence and confidence are what clients are really buying from their advisor, right? So it's that skill set, but also the mindset, right? And nothing erodes those qualities faster than being unprepared, especially when it comes to being unprepared for risk. Because like I said earlier, most clients do expect you to be prepared for that, have an action plan, and protect them from that. So a systematic framework that gives you a consistent process, something you and your clients can rely on no matter what the market throws at you. That consistency creates clarity, and clarity creates confidence. And that confidence is what keeps those relationships strong through every cycle. And of course, at the bottom line, helps advisors grow their asset base, right? I mean, that's what this is all about, is growing their asset base, helping people get to their retirement goals, and everybody making more money together, right?
Yeah, you win, I win type of situation, right? Everyone wants to win at the end of the day and have that sense of clarity, for sure. Yeah, like you talked a lot about it today. I mean, from the clarity standpoint to the process to having the confidence. What would you say the two things you would want an advisor to really get out of a conversation here about the Defender program?
Just that there's a better way to not only differentiate yourself in your practice, but also provide better outcomes for your clients financially, and that's just with a higher probability outcome. Rather than trying to pick stocks, and there's nothing wrong with picking stocks, but all the research has demonstrated through the years that it's almost impossible to pick stocks and then beat the market by doing that, certainly not on a risk-adjusted basis. So the easiest lever to pull is A, risk management, and then B, the second point is if you are able to control the risk side of the equation, the math of compounding just gets exponentially better. Now, we know compounding works over many years, but if you just take out or you minimize those down years, you'd be surprised how that equation changes. So those are the 2 points I would say, is that just having that process and then understanding that process is not only going to have that psychological benefit and mindset benefit, but also the big financial benefit and a differentiator for you in your practice. And again, in a time when competition is just on the rise, and you've got fee compression all over the place.
No, I really appreciate that. It's very helpful, and very helpful for the listeners as well. Vincent, really appreciate your time here today. Where can our listeners go and learn more about the Defender program?
Yeah, my pleasure. Thanks again for having me, Adam. It was a fun conversation, and obviously I think we fit really well with the topics here. So for the Defender program and how it works, visit viewright.ai. So that's the website, is just viewright.ai. And then obviously feel free to connect with me on LinkedIn. And for those who want to reach out directly, my email is vincent@viewrightadvisors.com.
Okay, great. It was viewrightai.com?
No, it's just viewright.ai.
Viewright.ai. Gotcha. Sorry about that. Viewright.ai. Thank you so much, Vincent, for your time here today. Really do appreciate it. Gave some great insight, ways to really help advisors and give them more confidence for themselves, but also confidence with their clients. So really appreciate the time, and thank you so much.
My pleasure, Adam. Thanks again.
Thank you, everybody, for listening to the Confident Advisor Practice Podcast. Have a great day.
The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors, LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors, LLC nor any of its representatives may give legal or tax advice. Pete Bush, Bill Bush, and Andy Bush are registered representatives offering securities and advisory services offered through Cetera Advisors, LLC, member FINRA SIPC, a broker-dealer and registered investment advisor. Adam Fagura is a registered administrative assistant of Cetera Advisors, LLC, member FINRA SIPC. Today's guest is not affiliated or registered with Cetera Advisors, LLC. Any information provided by our guest is in no way related to Cetera Advisors, LLC or its registered representatives. Cetera is under separate ownership from any other named entity. 15015 Jamestown Boulevard, Suite 100, Baton Rouge, Louisiana, 70810.